It's coming hard. Yeah, the next fiscal crash, next fiscal crisis, stock market crash, economic crash, you name it, it's coming. The question is, how do you, the average investor, the above average investor, the less than average investor, how do you prepare for this crash, for this economic downturn, for the stock market bubble to burst? It's actually a great question. And it really depends on a couple of things. I'm going to talk about all of that in this upcoming video. You know what it is. Like, subscribe, click the notification bell. Make sure you do whatever it is you can do to get more videos from channels just like this, particularly this channel. And let's dive right into the details. But let's talk about why the economy, the markets, and thus your net worth might crash in the next 30 days to 6 months, around that time frame. Start with the first and foremost, the upcoming election. No matter what your particular political philosophy is, there is a slight risk that whomever wins, be it the Republican nominee, the Democrat nominee, whomever you like, that the markets are going to react negatively. And that could have a domino effect on the markets and the confidence of the markets. While people are generally irrational about elections and things of that nature, that in and of itself is not necessarily a reason for the entire economy to go down. There could be other reasons behind all of that, and I need to make a separate video specifically on that topic. But changes in political leadership are a common reason for stocks and markets and economies to take a downturn. Let's talk about the obvious elephant in the room next. Stocks are at an all-time high. As you know, when there's only room to go down, that's when you typically tend to go down. Stocks have been going up higher and higher, and people are beginning to wonder, are these stock valuations based in rationality? Is there any reason for them to be this high? Some people say yes, other people say no. Generally speaking, depending on your economic and stock market trading philosophy, waiting for the stocks to get as high as they possibly can to begin to sell, a little bit of a fool's errand. I'm going to talk about that in a second here, but just keep that in mind that, yeah, stocks are beginning to look very high. Crypto is starting to be very high. The real estate market, it is as inflated as it's ever been in my lifetime, including 2008, 2009, 2006, 2007, before the housing crisis, as a matter of fact. Leading us to the next point, the economy has been growing since the last Great Recession. We talked about 2007, 2008. The economy has been growing steadily over time. There have been some dips, fluctuations, bear markets in the interim period. The downturn that I can think of most recently is the latest one in around 2020, the one around the virus, as we'll call it. It caused a massive downturn to occur. Frankly, that was a little bit of an anomaly, and if you were paying attention and you were bold, you would have made a lot of money during that downturn, knowing that it would come right back. I was not that bold, played it cautious, as a lot of people did, but there were some people that were bold and made a lot of money. Nevertheless, that's not the point of this video. The point is the economy has been growing steadily for a long period of time, since about 2012, since about 2012 till about now. And the question on many people's mind is, how high can it go? And many people are beginning to say that it can't get much higher than this, not without taking a downturn, making a correction, moving us in a more accurate direction for our economic and financial futures. And all that has been pointing to a downturn approaching. The question is, for any upcoming downturn, what can you do? Because as you know, if you're in finances and you're really into this sort of space, you really make your riches during downturns. So what can you do to be prepared for this upcoming downturn whenever it occurs? The next 30 days, the next 6 months, the next 6 years. Start off with understanding your strategy. Are you a passive investor? Passive investors have a different mindset, different philosophy, and a different plan of action than every other type of investor. I'll dive into the details coming up. But what do I mean by passive investor? Are you the type of individual that just wants to put your money someplace, let it grow for 10, 15, 20, 30 years, come back and take a look and see what your nest egg has become? Or you're a passive investor, whether that's in S&P 500 index funds, or that's buying real estate and letting your money sit in it as you build in equity, whether that's buying REITs, ETFs, sitting on crypto. One of the ways that I made some of my money is I bought Bitcoin early, kind of accidentally, not accidentally, but not knowing that it would grow as big as it did, and I just sat on it and let my wealth grow and grow and grow. So I passively invested in Bitcoin and other cryptocurrencies and let them grow steadily over time. Is that your strategy? Or maybe you're an active investor. The type of person that actively trades daily to try and make a little bit of money here and there every day. If you're an active investor or you're a passive investor, just make sure you understand what your strategy is, and that's going to lead you to the next step, doing your homework. Passive versus active, the homework is different. If you're a passive investor, your homework is all about learning about how passive investments really grow over time and how sticking with passive investments and not getting out and following the market trends is key to making money over time. There's a principle called dollar cost averaging, where You continue to buy into a specific asset class continuously over a long period of time, no matter what the price is, which enables you to efficiently allocate your dollars to that asset class. For example, if you're talking about an S&P 500 index fund, if that S&P 500 index fund were to go down during some kind of economic downturn, and you continue to invest in it, you're really purchasing that S&P 500 index fund when it goes on sale, giving you an opportunity to have more of it when it's cheaper. So when it comes back up, and as you continue to keep buying, the value of the shares that you've just purchased grow with it. And that can apply to many different avenues, right? Real estate prices have been going higher and higher and higher. If you're already purchased real estate, then that's good news for you, because that means your assets are going to grow higher and higher and higher. Your net worth is going to go higher and higher and higher. Your wealth is going to grow higher and higher and higher. But the thing is, if the market goes down and your value of your home goes down, you want to you want to keep investing in that home and in that strategy as the market goes down. So for example, if housing prices collapse over the next couple of months, I'm not sure if there's any impetus for that to happen, but if it does, you want to keep with your strategy, assuming you're not over leveraged, of course, which is an important lesson for any of us in any financial institution or in any financial asset class. But you want to continue if housing prices fall. You want to continue to keep investing in housing, purchase more houses, get into more assets. That way when the housing price goes back up, your wealth, your equity in those homes that you now own will go up with it. If you're an active investor, you already know what the score is. There are ways to profit in any type of market. Bull market, bear market. Active investors know if you think an asset class is going to grow, you're going to want to go long in that investment. That is to take a strategy and to purchase assets and financial instruments that enable you to take the long view of that asset. For example, purchasing a stock hoping it would go up. Then there's the opposite view. If we're in a bear market and you think that prices of stocks and other asset classes are going down, you're going to want to take the short view or use a short investment strategy. The details of both those strategies could take up entire videos on their own. So I'm going to leave that for a separate time. Make sure you're subscribed so you're there when that video drops. Actually, I believe I have a video on that on my channel right now, so take a look at my video catalog. Taking us to the next point. Learn about alternative investment strategies. There are a number of alternative investment strategies out there, and asset classes really. Think about things such as getting into art. Art's one of those asset classes that continues to rise even as other assets fall. Now there's a slight criticism of art as an investment class and class strategy. A number of them actually. A number of criticisms of art as an investment strategy. It's not really that liquid. You know, you give your money to some institution to purchase a painting or another work of art, and your money is kind of tied up for a period of time, and you can't really pull it out. Sort of a more general criticism is that investing in art is a little bit like money laundering, right? Does anybody really know what the true price of a piece of art is? The reply to that, the response to that criticism would be, really all these asset classes don't necessarily have a true value assigned to them. It's human beings trading and making decisions, economic decisions with each other that determines the value of all of these asset classes. So art is just as good as any other asset class. But then there are more traditional investment strategies. As you know, when stock prices fall, commodities tend to rise. Things like gold, silver, copper. People are always going to need actual commodities just to get things done from day to day. Gold's a little bit different in that it has an intrinsic value that humans appreciate and have appreciated for thousands of years. But it's not necessarily one of those things that people are going to need every day. Copper, silver is. All those commodities are things that people are going to want and are going to need to use and have been using all throughout history. The next step is to get your diamond hands. Whether you're a passive investor or an active investor, you're going to want to stick to your guns. Right? As a passive investor, we talked about this earlier. Maintain your investment allocation as much as you can, no matter what the economic opportunity, the economic situation is. Because one thing that's true about all economies is that eventually things turn around. And when they do, if you still maintain that investment, you're going to grow and you're going to be glad that you held on. It's the same thing with other investment strategies, right? Active investment strategies. If you're a true active investor, somebody that's put in the work to increase their skills and increase their knowledge on the investments and investment strategies that they're taking, when an economic downturn comes around, it's not the time to get all wobbly, to get weak in the knees, to get a limp spine. That's actually the time to double down on your strategies. But that doesn't mean to not change your strategies. Your strategies, and if you're an active investor, you already know, your strategies should assume that at some point the economy is going to take a turn for the worse. And knowing what to do in those situations are going to make you a lot of money. But the next thing and the final thing you're going to want to do is to take action. Don't just be a passive observer in the economic comings and goings of this world that we live in. Make sure that you have skin in the game. So when things change, when the economy, when stocks, when crypto take a turn for the worst, You're learning along with everybody else. And you're taking action along with everybody else. You're growing with everybody else. So when things turn around, you're not just observing people getting wealthier. You are getting wealthier. So if you got any value out of that video, guys, smash that like button. Comment down below with what your thoughts are, what your criticisms are, what your curiosities are on this video. Take a look at the videos on the screen right now for more great insights into this topic. And remember, a goal without a plan is a wish. A goal with a plan and no action. A goal with a plan and no action is a wish list. I'm Derek West. This is Finance Squared. I'll catch you in the next video. Peace.